Good evening, everybody. Okay, we're going to do stop losses. And I kind of do stop losses in a little bit of a different manner than, I guess, most. Because I guess the first rhetorical question is, what is the function of stop losses? And the obvious answer is to protect your capital, keep you from taking big losses, which is true. However, there's another important element that you want to do with stop losses, and that is basically maintaining your mental control. And then the third element is that when you take your stop losses at the appropriate place, you also have your funds available to put back into something that's acting positive. All right. So this is kind of goes with the theme of cutting your losses and letting your profits run. I always tell people that for 40 some odd years I've heard investment advisors tell you to cut your losses short and let your profits run. The only problem is they never tell you how you cut your losses short and let your profits run. So one of the first, first feedbacks is that people say, my investment advisor or my guy said that you shouldn't let your losses go any more than 3% or 6% or 7%. And my answer to that is the markets don't care where you bought. It's not the percent that is the losing element of a trade. It's basically the area that's telling you that the bears are, if you bought a bullish trade, where are the bears taking control? That's where you want to get back out. And that's one of the great benefits of candlesticks is that we're buying based upon expectations, upon buy signals, and I'm using buy signals also as going short on strong sell signals. And another key element of investing is even if you've got the best trading program in the world where you're getting 70% of your trades are winners, everybody says, yeah, that's great. I wish I could do that. But one thing that everybody forgets is what else can you expect from 70% winners? You can also expect 30% losers. And most people don't even address the losing elements of trading. And the reason for that is because it's an ego buster. When we put on a trade, it's because we, with our own intelligence, have analyzed when we should be in, and our intelligence said, yes, this is the time to be buying. And when it doesn't go in the direction that our analysis says it should go, that's kind of a slap in the side of the head to our ego, saying, boy, we must be stupid if we analyze something that should be going up and it turned right around and went down. That was my mental process for years. Because I always thought, because I was smarter than everybody else, when I decided it was time to buy, it's because everything that I analyzed was based on my smarts telling me this was the time to buy, and when it didn't work, something was wrong, because that meant I wasn't very smart, and you don't like to think that. So I was told when you place stop loss that traders can see other side. No. MP saying that when you put a stop loss in, that the other traders can see it. And there's two elements to that. First of all, if you're buying something based on the direction it should be moving, if it's moving back to where you put your stop loss, it means it's what your expectation of that price move was, is not working. So get back out of that trade and go on to something else. So in a nutshell, I know that every time I put on a trade, I have probably 1 in 3 chance that it's not going to work. When I realize that, I can close out trades now without that mental stigma that, boy, am I stupid, I got into a bad trade. I can already mentally rationalize, yep, this was a trade that didn't work. Hey, close it, let's move on to something else. So if we can figure out, there's 2 elements to improve this. One, our entry and exit strategies, to where we're looking for situations where we can improve that correct trade ratio to 70, whatever it is, 71.8 or 72%, so that our losing ratio drops to 27.9, 28.3, whatever it is. The more that we can improve our winning trade percentage, the more we're going to lower our losing trade percentage, obviously. But over the long run, that's going to improve your profitability megafold. So that's what we did, 28%. All right, so candlestick signals provide some visual benefits. First of all, it allows us for putting us into correct entry strategies and give us obvious stop loss levels. So if we're looking at a chart and we're seeing that this is the time to enter because we've got a bullish signal bouncing off the 50, if we can analyze all our elements that this is a time to be buying, we also have some very simple elements too, that if we're buying because we saw a buy signal and a close above the T line, where should it not trade or close? It should not close back below the T line and or back below the previous day's open, because that pretty much tells us that our expectation of going this direction is disappeared. We want to be back out of that trade. So this wasn't based on whether it moved back 3%, 6%, 7%. There could be trades that were off 13% by the time it showed us that it was time to be out of that trade. There's going to be 0.3%, and it's telling us we should be out of that trade. QT, yes, there's going to be times when you see something. And remember, we're buying based upon the probabilities of a price move because of investor sentiment. If news comes out tonight and says XYZ has something and it drops 13% in the morning, there's nothing you can do about that. Oh, I should rephrase that. There is something you can do about that. You can get out of that trade immediately because that's not the direction you expected it to move. So part of successful investing is looking at the chart or looking at your trade and saying, wait a minute, this isn't working. Even though I've got a loss, close it. Because the longer you stay in that loss and that trade's not working the way you expect it to, the longer your money's sitting there and you're debating what to do, that means the less time you have for taking that money that you still have, cashing it back to cash, and then going on to a positive trade that's going to get back that loss for you as quick as possible. And that all comes under money management, which we'll do some night, because that's, I mean, if I've got a bad trade in my portfolio and it's one out of my 10 trades, I usually can suck it up, because that one trade is probably being offset by hopefully 4, 5, 6, 7 other trades that are working well. What you are saying, get more amped up with options? No, not necessarily. Do you use actual hard stops on a trade, especially the day you put the trade on, or it's a future attack, you simply watch the price action after the entry? Randy, if I'm sitting here all day or most of the day, and I put on a trade and it's moving in the right direction, and I decide, all right, it shouldn't come back down through the today's open, I probably won't put in the stop if I'm sitting here. But if I decide that I'm got to be out for the afternoon, yeah, I'll put the stop in because it doesn't hurt you. There's been so many times that I have left the desk thinking, all right, everything's moving in my direction. I don't need to worry, and come back, and my first rhetorical question is, why the heck didn't you put a stop at this level? It takes 7 seconds to put in a stop at a level that it should not be trading. And there's been so many times when I've come back from someplace and said to myself, why didn't you just put a stop in? You would have saved yourself thousands of dollars. When a trade never works, are we short immediately? No, just because a trade isn't working doesn't mean it's going in the opposite direction. Just might mean it's not going up right now. Don, yes, but I don't look at it that I have to double my money on the next trade. I want to get out of the trade that's not working so that I can put my money back into some place where I'm making up some of those losses. All right, let me zip through a few of these, and then I'll come back and I'll answer. So the big, again, the logical stop loss is where you want to analyze what your charts are doing, and that usually is what the Japanese rice traders have identified is if you see a candlestick buy signal telling you the bulls are in control, they're saying if it closes more than halfway down that candle, then the bears are still in control. You close out the position. So this is why the halfway point of your bullish buy signal is very important, because if it comes back down through there, that's telling you the bulls aren't in control, the bears are still in control. Also, when you look at a chart, you've got to ask yourself, why are you buying this chart? And it's usually based on expectations that are coming from a candlestick buy signal. And again, I'll just use buy signal. And you also want the confirmation of that buy signal. So if I'm looking at a situation that says, all right, what should I be expecting off of the chart like this? I should be expecting upside. It's got every indication that with the stochastics turning up, a buy signal bouncing off the 50, closing up above the T line, that it's time to be buying. If I buy on a positive trade the next day and it closes but it's still above the T line, what do I need to see to stay in this trade? I need to see that it opens positive and trade positive. If it closes here, what's it telling us? It's telling us three things. One, they've closed it back below the halfway point of the candle that told us the bulls were in control. Two, they've closed it back below the T line. And three, what's it telling us about our chart pattern? It's pretty much telling us visually, this is not going up. This is fizzled. Get out of the trade. So as you can see, it was not the time to be in that trade. And just because it didn't go up, kind of answering the question from before, doesn't mean it's time to go short. It's just time not to buy until the next buy signal. So if I'm looking at this chart, saying, all right, we've got some buying going on, and there was a strong move. I was buying here today, but it closed down here. Where did it close? Just below the T line. Where should I set my stop? I shouldn't see it trade lower the next day. If it trades lower the next day, what's that basically telling us? It tells us they failed up here at the 50. This is not a good trade to be in. So this should all come back to the concept that 30% at least of your trades aren't going to work. So just make that a mental fact. And that will help you immensely. Saying, oops, this trade didn't work. Close out. Let me move on to the next one. Now, again, this all comes back to the money management aspect. You've heard probably heard me many times say I'd rather have, or I do usually have, probably 10 equal dollar amount positions in my portfolio, because if I've got a trade that doesn't work, the whole concept of candlestick signals are that your probabilities are that you're going to be in good trades. So even if I have a trade that's not working or a bad trade, I close it out because I know my overall portfolio is probably working well that day, that 5, 6, 7, 8 of the remaining trades are working positive. So I've got to expect that every single trade I put on is not going to be a good trade. So if I also know the doji rule, that if they're going to trade it in the direction of how they open it, but if they gap it down and trade back below the T-line, what's that telling us? Well, now I can pretty much see that there was a resistance level, and they failed at that resistance level when they should have gone through it. I close out the position. Or I set my stop at the previous day's low of a doji. Because if there's a doji and they are able to trade it back down below the low doji of the previous day, then you want to definitely be out of that trade. Because the probabilities say you see a doji followed by a gap down, you're probably heading lower. Close it out immediately. So the biggest element of candlesticks is we have expectations when we have a buy signal. So if this was our buy signal, and this was always hard for me, the next day they gap it down here, I always say my first inkling is, man, if they would just take it up one more time and let me out, I'd be so grateful. But what I discovered is, if you're in a trend and it's doing what it's supposed to be doing, and then all of a sudden they gap it in the opposite direction, that's exactly what it shouldn't be doing. Close out the trade immediately. A lot of people say, well, what if it can come back up a little bit and I can get out at a better price? That was not the reason you were in the trade in the first place. Close it out. Your stop loss in this case could have been below this level, because if they came back down through there, where do you think they were taken to at least? Back to the T-line. So you set your stops at places that would tell you that it shouldn't trade. If you were short this trade, where should it not trade? It shouldn't trade back up above the previous day's open, because they know, and especially if they gap it up, that's why we know what our candlestick signals look like. If we're in a trend and they gap it up and start trading the opposite direction, what type of signal do we have? We've got a bullish kicker signal, which tells me I definitely don't want to be short with a bullish kicker signal coming into play. So once again, the element of candlestick analysis is knowing what a chart pattern should be doing, what your expectations are, and knowing what the signals and patterns are telling you, so that if something does set up a signal that's opposite of what you're trading, tells you immediately, get out of that trade because that's not working. And what's our biggest fear about placing a stop loss? That they're going to come down and pick us off, and as soon as they pick us off, they're going to take it straight back up. That might be true if you're trading a very thinly traded stock and the market maker is able to move it around. But if you're trading a big stock price, they're not going to trade through 47,000 shares just to get to your 500 share order just so they can pick it off. So there's always another element, that if you think you've gotten picked off and the signal turns around and reverses, you can always buy back, because we're not trying to buy at the absolute bottom and sell at the absolute top. We're trying to get the fat part in between, and part of that fat part might mean that there are times we close it out and there's times we buy it back. I will get to that percentage of here in a little bit, as far as if you've got a loss, what do you have to do to make it back up. So there's very simple rules or simple applications. Again, our biggest fear is getting picked off, but this is the most important one about candlestick analysis. The candlestick signals should have expected results, and when those expected results negate, you close out the position. We also have elements of our analysis to say, all right, what should this be doing to be long and what shouldn't it be doing. Are in control. Well, if they gap it down, our alert should be we should have a stop at the previous day's open, because if there's a force movement in this direction, this far away from the T-line, where do you think they're going to move it to? They're probably bringing it back down to the T-line. If I get stopped out because of a close below the T-line, I can always buy back. Or if I see it's getting very indecisive, where's a logical place? And what should we see the next day if the T-line is acting as support? We should see it open positive and trade positive. Where should it not trade at all? It probably shouldn't come back down below the low of that doji. So again, there's the place to put your stop. That's telling you now, is that stop loss 7%, 3%, 0.3%, 20%? It doesn't matter. Because if you're in a situation where it's a 13% stop loss, it's probably in a situation where the upside potential is much greater. If you lack judgment, then do more testing and learn to gain more confidence. All right. When I see and so anytime I see a gap down, especially in the overbought condition, that tells me that's a force of sellers that shouldn't be there. I close out the position immediately. Now, does that make me disappointed that I didn't make this profitability up here versus this? Sure, but overall, if I can keep multiplying or compounding my returns by being in more correct trades versus holding on to losing trades, my compounding effect is much, much greater than hitting big winning trades every now and then. So this is what we call observe the candlestick obvious, that where is a place that we shouldn't be trading if we're starting to see losing or bearish signals. There's our bearish evening star signal. Still hasn't closed below the T-line, but on a day like this, where should it not trade? Well, here's a case where if I'm starting to see sell signals and the stochastics are heading down, some people ask, well, should you have your stop at the close or at the T-line? And that becomes a simple function of what is the overall market doing, and is this a stock that has been backing and filling and coming back up, or is this the first time it's really gone through the T-line after a sell signal? And the worst case scenario is you close it out when it comes down through the T-line. If it comes back up through the T-line, what's that telling you? They're not closing below the T-line. You can always buy it back. So here's one that we're in right now on the short side. Well, what's our expectation here? That we should be breaking out to the upside. So the next day, it does a little bit of indecisiveness, but the next day it closes below the T-line. What's that telling us about, again, our three elements? Number one, it's closing below the halfway point of the candle that told us the bulls are in control. It's closing below the T-line. And the third and most important element is, what's it doing with our chart pattern? It's pretty much telling us we're still in a downtrend. We didn't break out. So we bought this based upon the signals and the pattern telling us it was time to be buying. Somebody asked me today, why did I close out my SWKS trade? Because here was our expectation. There was a kicker signal. There was a doji yesterday, or not yesterday, a few days ago. What do we expect if this is going to break out? A positive open after a doji. Well, it opened lower, and it closed back below the T-line and below the open of that kicker signal. And what was the market doing? The market was trading off a couple of days ago. It came back up today, but what's this? So I close this out, but what's the magnitude or the strength of this chart right now? Not nearly what it would have been if it had broken out through this resistance level. So what do we have to look for now to get back into this trade? Well, I want to see what it does back at this resistance level. I can always buy back at that point. But my decision was not only based upon the fact that it closed below the candlestick kicker signal and below the T line. But if you cut the chart off right there, which way was this chart going? It definitely was not going up at the time. Why go against your probabilities? So if I've got a setup like this, what is our expectations? At least on a positive trade, we should be heading up to the T line. And I think I really goofed this one up somehow. If this was the bullish signal up here, that doji sandwich, if we bought on this day because it was trading positive after our Morningstar left-right combo, what's this candle telling us? The three things. Closed more than halfway down this candle, closed back below the T line, and told us that this trend was still in progress. Let's see. Same scenario. What do we expect? If this was our buy signal and it confirms the next day, where should it not trade back? If I bought here and it traded up through here, where should it not trade? It shouldn't trade back below the candle that told us the bulls were in control. You close out the position. Again, you're back below the T line. You're still in the downtrend. Your bullish signal didn't confirm. Close it out. And there are a lot of individual signals. We know the inverted hammer in the oversold condition, if it opens positive the next day, again, just my observations, nothing quantified, but more than likely, if it opens positive in the oversold area after an inverted hammer, you've got a 95% probability or greater that it's going to go positive, which makes it very simple. Where should it not trade? It should not trade back below this candle or the bottom of the inverted hammer, because if it should be going this way with a high degree of probability, it definitely should not be moving in this direction. So if I bought here and 10 minutes later was trading here, that told me they aren't taking it up. Close it out immediately. Now, that goes back to, if I close this out, what are the three elements that have helped me out with that, closing that trade right there at the logical place to close? One, I've cut my losses short. Two, I'm not sitting here wondering what to do with it for the rest of the day. So I've got my own mental control. And three, I've got that money now to go on to something else and put it into something positive. So this is what we always are analyzing when we do, at least buying a bullish trade. What should the trend be doing? Why did we analyze where it should be going? I mean, what were the signals? And what should be done when something alters that trend? So if this is our Morningstar signal, and this is bullish confirmation, and we're buying, oops, I goofed that up somewhere. Or did I? I guess I did. There's another lost screen somewhere. Oh, maybe that was it. Yeah, if we're buying because it should be moving up, it shouldn't trade back below the halfway points or the bottom of those signals. If I've got inverted hammers and it trades, opens positive, and I'm buying, it shouldn't close back below those signals that told us the bulls should be taking control. So we also use it for protecting our profits. What moving average is your trend? It all depends on the chart we're using. Obviously, we're using the T line as our primary factor. And then we use the other moving averages to kind of confirm what everybody else is doing. So when we're protecting profits, it also keeps our mental process clear. So if we're holding this position and we're starting to see dojis up here, again, where's a logical place they shouldn't be trading in the overbought condition? They shouldn't be coming back through the bottom of the dojis. Again, these are very simple candlestick analysis factors, is what should happen or what should not happen after we see a potential reversal signal. If we see exuberant buying, where do we start protecting our profits? If we wait for a sell signal, like way back down here, we've given up all these profits. So we still have our very simple parameters that if we're this far away from the T-line, let alone the 3T line, then we start flipping to our 10-minute chart. And we take profits. This is a case where on this day when it opened, it started trading lower, which was what was happening on the 10-minute chart. We took our profits. But then we got right back in again and took our profits up here. Why would we get back into a position that was way up in the overbought condition? Because what do we expect coming out of a fry pan bottom? A very strong price move. If we see a situation like this, where they have been moving up, where are we? Stochastics in the overbought area. And then they blast it. Where do most people buy? They buy exuberantly at the top. So that's another case where if we see them blasting away up, we flip to the 10-minute chart. 10-minute chart says, get out here. We're getting some profit taking. Why would we take profits here on this 10-minute chart? Because our daily chart was telling us we're way, way up above the T-line. It's time to start watching for potential selling. If we see a big breakout and it moves up big in one day, we still don't have a sell signal when it's trading up here. But what do we know about this big price move? We're way above the T-line. You just flip to your 10-minute chart. What's the worst case scenario? We take our profits up here and we can buy back when we see the next buy signal on the 10-minute chart. The 3T line is the 3 exponential moving average, which when worked in conjunction with the T-line, it just gives you a little bit more faster. There's techniques for how to use the combination of those moving averages to get in and out of trades. So again, using the visual elements of the charts, you don't have to worry about formulas. You don't have to worry about price percentages. It's just common sense visual analysis. And remember, we're using the most consistent of all graphics or chart patterns in the world, and that's one very simple element that works over and over, and that's human emotions. So anyways, that's, let me go back. Let's see. I think for any new people in here, Becky, you want to put up the link? I think Pat's, there we go. I think Pat's given everybody a free 5-day trial to our chat room during the day just so people can see what's going on. And we kind of try to use these same trading techniques during the day to point things out. So when we do a session like this, it's sort of put it in your head what is the logical thing to do. But then as we keep going over and over, it kind of reinforces your learning process. Would you advise a student to have their stop too tight or too loose if they don't have the sufficient judgment yet? Marty, you make it a little bit looser. Again, you pick out a spot on the chart that would say, all right, the price should not come back through this specific level. I would rather be a little bit too wrong on the loose side than get stopped out and then have everything move back up because it didn't really confirm. Many brokers offer trade timing tools. Think or Swim, for instance, where an automatic order can close in the last few minutes if the T line has been crossed. Similar orders can be used. Yes, there's all sorts of ways. And I think, Don, we're going to have you on some night to show all the different techniques that can be used from some of the brokerage firms. Arvind, whether you use the T-line for the close, if you're in an uptrend and the stochastics are in an uptrend, not in the overbought condition. Let me see if you probably want to wait for it to close below the T-line. If you're up in the overbought condition, and when we see a sell signal in the overbought condition, if it opens lower, where do we expect it to move to? Probably back to the T-line. So if it opens lower, you might take your profits. And then the worst case scenario is it trades down. And then when it comes back up above the T-line or opens positive the next day, you can always buy it back. So depending on where you are compared to the T-line, as long as that, well, this one is a good example, but a lot of times you'll see where they open, they trade down through and come back up. As long as your stochastics are still heading in the upward direction, it's telling you that it wasn't time to close out just yet. Let's see. Let me go back down to the bottom. Yes, Gunny. The question is, do you have a device for tightening your stops? If I'm in an overbought condition, I will close or I will put my stop. If this one closed up here and opens up here, I put my stop at the previous day's open. If it's closed here and starts trading up the next day, I put my stop at the previous day's open. Because logic says if they open positive and trade back down below that level, like here, that means the sellers have started to take control. I notice using daily charts. Do other time frames work? Yes, they all work. Candlestick signals work just as well. Candlestick signals are the accumulative knowledge of everybody buying and selling during any particular time frame. Whether you're trading off the 1 minute, 3 minute, 10-minute chart combination, which I used to do trading the E-minis, or you're swing trading, or your long-term investing. Long-term investors might use daily, weekly, monthly. I trade commodities, so I'm usually using the 10-minute chart. And when I get ready to buy, I drop down to my 5-minute and 1-minute chart. So as we can see in the crude oil prices, yesterday we took profits because we are this far away from the T-line. So we took profits by trading off the 10-minute chart. Notice the whole way up, they really couldn't close below the 10-minute chart. Then what did we start seeing on the 10-minute chart? Some shooting stars and a close below the T-line. What's the worst case scenario? You're out. You can get back in. Then they closed it back out again, close out the trade, which was good. Or you can start going short. Why would you start thinking about going short? Because notice what we had. We had a shooting star doji in the overbought condition, that far away from the T-line. On the 10-minute chart, where do you think they were going to take the daily? Back down to the T-line. You show the examples of buy signals even if it's trading below the 50-day moving average. Is that quite risky? No, we're not trading the moving averages. If you want to be safe and cut your opportunities to be in good trades by great percentage, then just trade above the 50-day moving average. But if you're in a market that has been selling off for the last 2 months, and then all of a sudden there's a buy signal, you may miss out on tremendous profits if you're waiting for it to come back up to the 50-day moving average. With the room call-out trades, yes, SS, we've got about anywhere from 250 to 275 people in the trading room, and there's a good number of traders in there that will put out trades and explain what the pattern is. Not so that you have trades, but you also have the opportunity to go look at that chart. And if you were wondering why Peter put out a trade on XYZ, you could always come back and say, what did you see, Peter, that made you want to buy XYZ? And they'll explain it bounced off the 50, it did a Morningstar signal, so it kind of uh, speeds up your learning process. I do trailing stops once the trades get up in the overbought condition, meaning stochastics above 80. Also, SS, I put out 2 or 3 stock picks every night on in our members area with a short video of why those were being picked. So again, you're going through a constant learning process. What are the hours that are best? What are the hours that are best? Carol, what is that for trading? It depends on how fast a trader you are. If you're trading, let's say off the hourly chart, what chart are we on right now? The daily. If I'm trading off the 10-minute chart, yes, I might go short. If I was trading off the hourly chart, yeah, in this case, it still showed you could go short. Yes. So depending on how fast a trader you are, yeah, this one, I mean, these are, you can basically see what's happening even if you're looking at Western patterns where we had a high, came down, came back up, started seeing sell signals, and they couldn't reach the recent high. Notice what happened after a sell signals. They closed back below the T-line. What did that tell us? They weren't going up. They were probably taking it down. Where was the time to take profits? Once we started seeing buy signals and it closed back up above the T-line. Would we get back into a short trade? Certainly. Saw a left-right combo and closing back below. What was this telling us? They were rolling it back over. We're getting ready for the next short trade. Other experts have told us that there are 2 periods. 1.5 hours after the opening, and 1 to 2 in the PM. Yeah, that's logical. And if you want, you take your 5-minute chart or 10-minute chart, just go back each day and see where that's most likely to occur. But again, all depends on what type of trading you're doing. Joey, we have scalpers, day traders, swing traders, long-term investors in the room. And we're not trying to teach people how to day trade or swing trade or scalp. We're just showing people how to analyze the chart so you can apply the type of trading you'd like to do, but have something to work off of. Like the charts. The 3T line is a whole another session. Let me see if there's a way to, but the 3T line, the further it moves away, or the further the price moves away from the T line, the more effective the 3T line comes into effect, or the more importance comes into effect. I come into the trading room. I usually make comments on the open, just usually type comments. Occasionally I'll come in and do a quick point of interest on something where somebody might be asking questions and it's easier to come in and answer it verbally than typing it in. Then I usually try to come in for an hour, usually stretches out to an hour and a half around noon time. And then again, another 30 minutes or so at the close. But because I'm sitting here trading most of the day, if there's something going on in the room where somebody has a question or they're trying to figure out something, I'll pop in and give an answer. Oh, Jennifer, when you have AM session, your time, I do not get your message until PM Eastern. Jennifer, I don't know the answer to that. Are there any stocks you don't like to trade? Oh, it's an irrational reason, but I don't trade the utilities because when I first became a stockbroker, I was working for Kidder Peabody in Houston, Texas in the mid-70s. And back then, the Dow was going from 750 to 1,000, back to 750 to 1,000. Did that for 8 years. And the biggest money or investment program then was you would buy utilities that had an 8.3% dividend yield. And if you could buy them for 14 and they went to 15 over the next year and you made an extra 5% on the stock, that meant you had an overall 13% yield. So I have a hard time trading utilities, but utilities right now trade just like a high-tech stock. But I tell people, if there's something that you don't like to trade, or if you just got nipped 3 times on Amazon, and you say to yourself, man, I'm not going to trade Amazon anymore, the answer to that is, if you're looking at a chart, and it's Amazon, and it looks good, put your hand up over the symbol on that chart, and then ask yourself, would I be buying or selling? Because the market doesn't care what has happened to you in the past. The price is going to move based upon what the chart is telling you is happening right now. If you buy and sell ETF, a stock ETF more than 4 times in 5 trading days, the broker would ding you for pattern trading unless you have a huge account. I think you're all right as long as you have more than $25,000 in the account. Is that right? I trade futures, yes. I trade options, stocks, and futures. When you get correctly into a trade, you consider like Elliott wave analysis to go further, or candles only? Only candles only. Dennis, I've discovered, being in the Market Technicians Association, that you can fit 10 Elliott wave analysts in a room, and you can put up a chart and ask them what wave it's on. You'll get 40 different answers. It's very subjective. All I'm caring about is wave 1, wave 2, wave 3. When wave 3 is over, it becomes wave 1, wave 2, and then I'm looking for the next wave 3. Let's see. Is it okay to buy calls and puts instead of stock for day trading? You can if you're nimble enough to do that. I occasionally day trade options by accident. That if I buy something and it's moved huge that day, yeah, I'm going to take my profits. Please show the 3 ways more clearly. Well, let's see. This to me is wave 1. This is wave 2. And when I see wave 2 and it starts rolling over, what do I expect? I expect wave 3. Now, do I count wave 1, 2, 3, 4, 5 with an ABC correction? No, because I'm not going to be in a trade that long. I'm only in the next trade that chart is telling me. Is there a past webcast on option spreads? There should be, Bobby. You just have to look in the archived trainings. When you trade options, the bid-ask spread slippage need to overcome. Yes, when we do our option training, that's one of the things that we express, is that you've got to overcome the bid-ask spread, and then your commission percentage is much greater because obviously you're not putting as much money into an option trade as you are a stock trade. And you still have to be correct in the direction to a magnitude that you're overcoming your premium on that trade. James, we'll have to look at individual stocks here in a minute. Joseph, depending on how you're bigger, I don't know how big your account has to be to get past those trade regulations. KZ, that's up to each individual. I do both. Yes, there's a recording of this. Yes, you're only buying the options, Arvind, because of the underlying entity. You're not buying options because of the price of the options. You're buying the options as a method to buy the underlying stock. So if the underlying stock is showing a good buy pattern, then you're buying calls because that's a much more leveraged method to buy that stock. If that stock all of a sudden shows a sell signal, then you close out. If you were selling the stock because of that, you'd sell the stock. If you own the options, because that's the way method of owning that stock, you close the options. So the underlying trading entity is what you're trading. The options are just the method for buying that. Okay, let's take a look at a few that we were looking at today. We'd recommended QURE. Whoops. If it traded positive, which it didn't. So this is part of the entry and exit strategies. That what do we want to see to confirm this breakout for it to open positive? There was another one just like that. Was it GRUE? No, I forget which one it was. DYAX was one that has that little mini scoop pattern, and it started trading back positive. So again, this is where you kind of observe the obvious. Which direction is this moving? It's an uptrend, and where has it basically not closed? Below the T line. Now you have a little scoop pattern. Look for more upside. In regards to breakouts, are you worried about having stochastic support? No. On a breakout, we're looking at what the pattern is. I am on a 10-minute chart. If that ain't a fine howdy do. Okay, that looks more like it. Notice DYAX had the little kind of kicker signal and then confirmed by staying above the T line. If it trades positive, what else is it doing? It's confirming this, and it's breaking out through this downtrending channel. So remember, stochastics are just a confirming indicator. The number one reason you're buying or selling is based upon the signal. Then everything else becomes a confirming indicator. Tahoe, which also came out of this fry pan bottom bobble type pattern, has pulled back. And notice the pullback. It's very indecisive. And notice where it couldn't close today. Couldn't close below the T line. So what's our assumption? That if it opens positive, you want to be buying on this J-hook pattern. Because if this is wave 1, where's wave 3? Probably going up here to the 200-day moving average. GIMO is another one that we're in, and it held up. It's been holding up above the T line. Now we're looking for it to break out through this level. Kind of the stepstone uptrend. They take it up, move sideways. Take it up, move sideways. Now we're looking for the next pop to the upside. And AGEN, there's your fry pan bottom. This is what we call the classic. Where was our sell signal? You had a doji up here in the overbought condition, and it was followed by a bearish engulfing signal. It was time to take profits. Where was the next likely target? Pulling back to the T line. Once they got to the T line area, notice what's happened. They had the piercing signal and a doji today. What's that mean if it opens positive? We've got a doji sandwich in progress, which means our J-hook pattern is in progress. Sorry about that. In ADXS, did we just do this one? Yes. Oh, no, we didn't. ADXS, also another J-hook pattern in progress. You can be buying this one on positive trading. We're still in LVTC. Did I say that? VLTC. because there's one strong characteristic to this chart, which is this stock has moved from basically $1.50 or $1 to $22 in the matter of 3 weeks. Now it's pulled back, and where's it trading? It's just now climbed back up again above the T line. If it opens positive tomorrow, doing a doji sandwich, it's kind of broken this little downtrending channel and telling us that if it starts wave 3, with this being wave 1, wave 2, wave 3 could take you up into the $45 area. What are the day spreads on these stocks? I don't know that question, JR. The day spreads. Yeah, I don't understand the question. Intraday. Okay, we did BPT, and this was, again, a prime example of when to start taking profits. When you see a sell signal in the overbought area, if this was in an uptrend, what should it do after a sell signal? To stay in it, it needed open positive and trade positive. The fact that it gapped down was time to take profits. You can always buy this back on positive trading, because what type of pattern would that be setting up? Another J-hook pattern. Could mean day range. I don't know what the day ranges are. I don't really care about the day ranges, because that's all going to be built into the charts. Hawaiian Air. Looks like it's setting up for its next wave to the upside. And we were long WLL, waiting, both on a long-term and on a trade basis. But notice what's happened to the trade. We're back below the T line. It's rolling over. It's time to be out of this. You can always buy it back. But right now it's telling us that selling is occurring. Apple, kind of the same scenario. We had a fry pan bottom. And what do we know? What are we looking for at a 5-pan bottom breakout? We're looking for the breakout. If we see a left-right combo, what's that telling us about this area? That it's acting as a double top instead of a breakout area. It was time to get out of this trade. I don't know whether I'd be short because of the support level here. I might be short if it opens weaker tomorrow and does a bearish doji sandwich. Hold on to your individual ones. Let me get through a few charts here. JMEI, another one that was pointed out in the chat room today. This one you get ready to buy on positive trading tomorrow because of the J-hook pattern setup. NVGN, another J-hook pattern. And a J-hook pattern is very easy to identify. Is once you see the pullback indecisive and start back up again, that means the profit taking is over from that first move. Get ready for the same type of move for the next upside. And BFNT, I did that wrong. BNFT. There's your scoop type pattern. There's your hammer, a little gap up. You definitely can be buying this one on positive trading. Remember, the bigger the signal, the more compelling there's been a change of investor sentiment. Same thing with one that was pointed out in the chat room today, GIVO. There's your gap up. Let's make this a little bit smaller. You can see the trend that it broke. And how did it do it? With a huge day to the upside, and this day to the upside was kind of a doji gap up, your best friend. I would suspect a 45 degree to come off of here. Remember, once again, the bigger the signal, the more compelling there's been a change of investor sentiment. So those are the longs. We're staying short on ONDK because it essentially did a bearish doji sandwich today after a bearish kicker signal. You can see it rolling over. When they were rolling over, they did a kicker signal. That means there's going to be a lot of force to the downside. Things like ZAG. Notice you had this big, long-legged doji, and then they told you which way they were taking it afterwards. This one you can be shorting with the expectation they're probably coming back down to the original trend here at the 200-day moving average. Oh, let's see what happened on Apple. It moved up 77 cents today. I don't know the answer to that. Nope, showing on both charts that it was only up 25 cents today. And Zoo was another one that I was just about ready to get to on the long side. That's what you call your belt hold signal. The belt hold signal is named by the Japanese race traders as the wrestlers fighting, and one's trying to back out of the circle. The other one grabs his belt and pulls it back in. So that's a big, huge 2-day belt hold. This one you get ready to buy on positive trading. What does a belt hold signal tell you? That there was lots of sellers and they were wiped out. The bulls stepped in, so there's no sellers in the way at this point. The lines on the chart, let's see if I've got all of them. The blue line is the 50-day simple moving average. The gray line is the 20-day simple moving average. And the red line is the 200-day simple moving average. Again, those are all on our charts because every major money manager around the world uses those moving averages to make their decisions. The black line is the T-line. We call that the T-line because it's called the trigger line. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close back below the T-line, and vice versa. If you see a sell signal and a close below the T-line, you can stay short until you see a candlestick buy signal and a close back up above the T-line. Tesla, another belt hold type signal. Notice they took out a lot of sellers, took it back up. That means a lot of sellers out of the way. You're above the T-line. Notice what they haven't been able to do this whole way up. They haven't been able to close it below the T-line. You stay long on Tesla. Netflix, still supporting right here above the T-line. It's moving sideways, obviously, so if you weren't in it, or if you're not in it, you can put a buy stop right up here. If it comes up through this level, it tells you wave 3 is now in progress. G-Pro, yeah, you can buy this one on positive trading tomorrow. Let's see what AMBA is doing. AMBA has gone flat. It's probably moving sideways until the 50-day moving average catches up. Amazon is a nice looking chart. You probably want to be buying this one on positive trading tomorrow because notice where the consolidation ended. Well, remember, these are indecisive signals, and where are those signals occurring? Right on the T-line. What was today's positive trading? Telling you which decision they made after that indecisive period. Twitter, you stay short. Now, if I was short and it opened positive tomorrow, I'd probably take profits because you're in the oversold area. You had a hammer followed by a bullish engulfing signal. Where's the next logical target? They're going to bounce it back up to the T-line. Gap up. I forgot which one I just typed in. QRVO. I'd watch for a 45 degree to come off of here. Sun Edison. Here's your kicker signal. Off the 50 through the T-line. Now expect a 45 degree, probably the same trajectory as what the trend was before the uptrend. The green line, the little green line is the 3T line. And we'll do a whole session on that, how you use the 3T line with the T line. Could you detail 45 degree? A 45 degree is usually when you see a very strong price move that tells you there's been a change of investor sentiment. Usually there's kind of a steady uptrend after that, and all you have to do is stay long as it doesn't close below the T line. Okay, we're already late. Let me do just a few more. SEMP, still nothing here. It needs to get back up above the T line to get back into it. And GMCR, this one, you can see the slow curve, you can see the evening star. Right now, I would stay short until I see a confirmed buy signal. We're staying short in Bigalow because we're still falling through after this big gap down and the break of the bottom of this kind of spreading formation. Even though it did a bullish harami today, it makes it very simple. If it opens positive, they're going to bounce it back up to the T line. But if they can't close it above the T line, we'll reshort it. If it opens lower than that tomorrow, obviously we stay short. Facebook really hasn't had anything too exciting. It's back on the support level, but you don't buy this one until they can close it above the T line. BDSI, you stay short with the anticipation they're bringing this back down to the 200-day moving average. Yahoo. This is what we call the message. So the message is they gapped it up today, but there's profit taking. So all we do is start watching to see what the signals tell us that the profit taking's over. Then you can start buying. Yelp, another one that you can buy based on a 45 degree coming off of here. Schlumberger, you want to be going short if it opens weaker tomorrow. Disney, you want to be out of. Disney, you can always buy it back if it comes back up above the T line. Unfortunately with Disney, even though it's in a slow, steady uptrend, the magnitude of return is extremely small, so it's definitely just a long-term hold. The SPY, as you can see, is indecisive as all the indexes are in the wedge formation, but they're still toying around with the lower end of that wedge formation. KAR, right now you stay short until you see a buy signal. Today's positive trading was not a buy signal. It was just a up day and a downtrend. Whoops, that was CVC, CVS. Right now I'd be short this one. I would anticipate you've got a slow, steady downtrend until the 200 catches up. Zyop, you can stay long. You just have to be very conscious of this level right here, that it has to break out through this through that downtrending channel. Microsoft, I'd never trade because it's just a slow mover. Right now, again, you saw where the sell signals were up here, the shooting star, the bearish harami. And where did they tell you they're going to bring it back to at least back down to the T line? Right now, if I was anything, I'd be short until they can close it back up above the T line. But the magnitude of return on this one is so small that it's hardly worth trading. Avid, nothing you can do here. I wouldn't be in it until they do close it back up above the T line. Last, I wouldn't be long or short this one. You can see you're stuck in a sideways mode. There's probably better places to have your money. Let's see. Bed Bath & Beyond. You start looking for a buy signal, but Bed Bath & Beyond, as you can see, is still in a downtrend. Probably wouldn't be long or short this one. THM, left-right combo today. If you're short, you should have closed it with it coming back up to the high of today's doji, or yesterday's doji. If you're looking to go long, it needs to close up above the T-line. Let's see, Holy Frontier. That's got kind of the little bobble here. If they open this positive, you can buy it because it's broken out, and you're still in kind of in a J-hook pattern. SSYS, you stay short. There's nothing here. LYB, this one you get ready to short if it opens weaker tomorrow. If you should be out of this one because of the sell signals and then the close below the T-line. You can always buy it back if it comes back up above the T-line or closes above the T-line. Southwest still in a slow downtrending channel. Another, unfortunately, it's become an institutional trader, so it doesn't have a whole lot of magnitude of movement. We did Tesla panel. I wouldn't be long or short this one because of the lack of magnitude in it again. And it's a very, very slow trending price move. Again, something that if you want it, you put it away for long term. Save. If it opens positive and you're short, it's going to pop up in the T-line, then you see what it does from there. Panera Bread. I wouldn't be long or short this one right now because your stochastics are straight sideways, your price is straight sideways, you're right on the T-line, you have a doji. Pretty much it's going to tell you that it's going to move in the direction of how they open it after a doji. Right now, all you can do is stay short. That was a good slow curve. That's what we're looking for, is the setups where your next pattern is getting ready to take place. They usually can slam them pretty hard, making them good short trades. Glue, all you can do with this one is stay long as it stays above the T-line. AXTA, another one where you stay long as it stays above the T-line. ICPT, probably wouldn't be long or short this one. Just not enough movement to make it worthwhile. There's no trend to it. AFOP, probably the same scenario. I wouldn't be long or short this one right now. Just not enough trend to it to make it be able to analyze what it's doing. eBay, same thing. eBay, after it popped up, should have closed out when it closed below the T-line and closed below the T-line again. Right now it's in a downtrend. Nothing here to get real excited about. I'll try to find a bobble here for you. And I know a bobble was why we bought PTC. A bobble is when you come up, you hit a resistance level, it pulls back, but they can't close it below the T-line, so a bobble's in here. And then you can be buying it when it comes back up through the resistance level a second time. Con, that was on my chart. That one can be bought. THX, or is that, thanks, I've got a THS. That's what we're looking for, is these things that are getting ready to crunch. You stay short on this one. Stem cell, nothing here yet. Now you've got a support level. You can buy this one on positive trading. Just have to make sure it stays above the T-line after that. FCS, very slow uptrend. You can stay long on this one. We did panel. GD, Another one you can stay long, but not a real exciting trader because of the institutional trading. Oil was down today, did an evening star signal, so there might be some backing off of oil here for the next few days. Shack, get ready to go short with the anticipation it could come back to the 50. ALNY. Nothing here to get excited about one way or the other until you see either a strong buy signal or a strong sell signal. Under Armour, ever since the kicker signal, you've been in a downtrend. At this point, if I was short, I would have covered it, but I'd be ready to go short again now that they've shown that if they start selling it off from here, that it has failed at the T-line. JGW, nothing here either. That's a very, very slow mover. I wouldn't be long or short this one. XLB did a kind of a bullish engulfing signal. You can still own this one on positive trading tomorrow, telling you they couldn't close it below the T-line. The T-line is the 8 exponential moving average. SPLK. You got a little morning star signal. You can buy this one on positive trading tomorrow, kind of doing the J-hook pattern. And price line. Price line, you get ready to short if this opens weaker tomorrow. You had that doji gap down. CRM, you stay long on this one as long as it stays above the T-line. The 10 or the 20-year notes are still trading down. It didn't do a reversal today. It just had an up day and a downtrend. So I would suspect there's going to be a bounce back up to the T-line, but nothing that tells you there's going to be a strong uptrend. ZIL, nothing here that would get me excited one way or the other, moving sideways. Oh, somebody was asking, what do you mean by not enough movement? Some stocks are institutional traders. It means they have tons of following, but they don't move very much. They may move 10% in 3 months or 6 months. They're institutional type traders where the institutions buy them and then just put them away for a while. Glue. I thought somebody said glue was one that Tazar was an example of just because somebody downgrades it, that doesn't mean, all that means is that that's somebody's opinion. Until they can close this below the T-line, it tells you investor sentiment is still taking this in an upward direction. BTU, nothing to get excited about here. You can't short it because it's below $5. I wouldn't be doing anything on this one. USL, get ready to short this one. That's the fuel fund. All right. Kroger, you can get ready to buy. Kroger had that kind of steady Eddie chart for quite a while where all you had to do is stay long, take your profits if it closed below the T-line, buy it back if it came above the T-line until you saw it close below the T-line, and it doesn't come back up above the T-line until today. John, I don't care about institutional ownership of a stock. All I care is about the price. Let's see, UAN, you'd be out of this one. Tells you the breakout failed. Oh, okay. Blue mentioned, I see what you're saying. All right. Okay, we're going to have to call it a night. My throat's getting a little bit dry. You don't look at volume. It's not under your, you don't look at volume. It is not under your indicator list. No. volume has nothing to do with price. A lot of people say, oh, I want to see the volume go up as the price goes up. Volume and price have absolutely nothing to do with each other. If nobody's willing to sell you a stock and if people are willing to buy it, it's going to go up on small volume. I'm only buying price. And let's see, this is CVEO. You just stay long on this as long as it stays above the T line. Okay, sorry to have to cut it short. My throat is getting a little bit rough here. So with that, we'll see everybody bright and early in the chat rooms tomorrow. Everybody have a good evening. We'll see you then.